Lewis Prescott from Mingshi Investment Management. Welcome to the Equities and Growth Assets Symposium.
Thank you.
Can you explain the approach of the China equity strategy you've just launched in Australia?
Right, so we've actually launched two funds, and they're both China A-share focused. That means the China onshore market, and we take a systematic approach to investing, so quantitative signals, and we're launching a long-only and a market-neutral product.
And what does the investment universe of those look like in terms of size and scale?
So we cover the entire China A-share market, excluding the bottom 30%, so around 2,500 names in the onshore China market.
And with that quantitative approach that you use, how should advisors be blending that with traditional equity allocations?
Well, I think that's a key word, the blending of different strategies, because what you're looking for when you look for diversity in managers in general is different risk and return profiles, and that's what we believe we are offering with a quantitative portfolio. It's far more liquid, it's far more diversified, and I think traditionally people have gone to China with very concentrated positions in large thematics, and what we offer is a highly liquid, highly diversified portfolio which has quite a different alpha and risk profile.
And the returns over the last 12 months or so have been exceptional compared to a benchmark that's been quite difficult. Could you explain some of the drivers of that?
So our benchmark for our offshore long-only fund, which is what we're launching in Australia, is the MSCI China A Onshore Index, which is around the top 750 names. And in 2021, we outperformed the index by 18% with a realized Sharpe of 3.5, which is, incredible performance that you don't really find in meaningful size funds outside of the A-share market. And the drivers are really the elements I spoke about before, not having large concentrated positions in stocks or sectors that could be affected by government intervention or different risks. Really, you're clipping that consistent alpha through systematic portfolio approach. 2021 was a good example of outperformance.
And how are there certain factors that are more persistent in China versus in other parts of the world?
Yes. Now, this is quite a general answer because it simplifies it a little bit. But, for the purpose of this, momentum, for example, is a celebrated factor in US markets, right? Momentum has done very well. What you'll find in China over the last decade, it's very much a reversal market. A high retail contingent of participants really, doesn't follow that US-centric momentum landscape. Now, that's high level. We're doing, we've got tens of thousands of, features that we're looking at. But that's, an example of how the China A-share market is very, very different from major US, Australian, European markets that we're used to.
And what are some of the nuances of China A shares that warrant active management versus the benchmark?
Everything is different in the China A share market compared to the price discovery and mechanisms that you would see in the US or Australia. So very limited single stock shorting, high barriers to entry, limited products available like limited derivatives, very limited ETFs, which are a huge part of US and Australian market, and then the players themselves. Again, this high retail contingent means that it operates very differently to global markets, and with that difference comes opportunity in being a specialist. And so that's why active management, or at least specialization dedicated to the A-share market, really has a huge advantage over taking developed market strategies like passive ETFs and applying them to China.
Lewis Prescott, thank you.
Thanks. Appreciate it.